Welcome back to the Pro Ticker Podcast, everyone. It's your Monday morning edition.
Covering all those major financial magazine headlines.
You got it. And hey, a big welcome to the deep dive.
Absolutely.
Now look, we all struggle with it, sifting through all those articles,
So much financial news.
trying to figure out what to pay attention to, right?
It can be overwhelming.
But that's why we're here, right?
We pull out the really important stuff.
The insights that actually give you a handle on what's actually moving these markets.
We cut through all the noise and the jargon, and we just give you what you need to know.
Exactly. We're like your informed friends, just breaking it all down.
Exactly.
So today is Monday, March 24th, 2025.
Wow, already.
I know, right?
Time flies.
And we've got a really interesting mix of headlines today from our usual sources.
Our favorites.
Bloomberg Market Watch.
Yeah, they always give us a good picture of what's going on.
And they paint a picture today of a really dynamic economic landscape.
It really does feel that way, doesn't it?
I mean,
Every time you open up, a website or app,
you can't get away from it.
there's something about trade wars, potential trade wars, this inflation puzzle that just seems to be ongoing.
Ongoing. Yeah.
And then, are we heading for a correction?
Yeah. Is this market,
Is it overheating?
overheat? Yeah. All the big questions.
Yeah, so it can feel like you're putting together a really complex puzzle.
It does feel like that sometimes. Yeah.
Right.
And so for this deep dive, our mission is to take all those seemingly separate pieces
Yeah.
and show how they all fit together.
And why they matter.
Give you that clearer perspective on what's actually happening and why should I care about this, right?
Absolutely.
Okay, so let's unpack this. And I think a good place to start is something that's got a lot of people talking around you.
Yeah.
Those tariffs that are coming from President Trump.
Right. Right. And Bloomberg and MarketWatch have both been covering this. The lead up to what some are calling Tariff Liberation Day.
Liberation Day.
I know, right? A little bit ironic, right on April 2nd.
Okay, so what was the big concern at first?
Well, I think the initial worry was that we were going to see really broad reciprocal tariffs.
Okay.
The kind that could really disrupt global trade.
Yeah, where everyone's just slapping tariffs on everything.
Exactly. Yeah.
And then, you see those prices at the store going up.
Exactly. And then international commerce slows down.
Yeah, nobody wins.
Nobody wins, right?
But here's where it gets interesting.
Okay.
Some more recent reporting, specifically from Bloomberg, suggests that we might actually see a more selective approach.
Oh, interesting.
Yeah. So they had two articles. One was titled, U.S. Treasuries Fall on Signs That Trump Will Dilute April Tariffs.
Okay.
And the other one was Stocks Gain on Prospect of Targeted U.S. Tariffs, Markets Wrap.
Okay, so it sounds like they're thinking maybe he's not going to go as broad as we thought.
That's what it sounds like, yeah.
Interesting. How did the markets react to that?
Well, what's fascinating is how quickly they reacted. So Bloomberg highlighted that as soon as this kind of more targeted tariff idea came out, stocks rallied.
Okay.
And we saw a little bit of a dip in Treasury yields.
So for our listeners who, might not follow this as closely,
Yeah.
when Treasury yields fall, what does that mean?
It means that the price of those government bonds has actually gone up a little bit,
Okay.
which can mean that investors are,
Looking for safety.
moving toward those safer assets.
I see.
So this little shift that we saw suggests that investors were moving away from that safe trade and into riskier assets
Okay.
because they think maybe these huge widespread tariffs might not actually happen.
I see. So a little more optimism creeping in.
Yeah, a little bit of optimism for sure.
Interesting. And this wasn't just in the U.S., was it?
It was not, no.
Bloomberg talked about how this was happening in Europe as well.
Yeah, so in that Stocks Gain article, they mentioned that sectors in Europe that are, really sensitive to tariffs,
Like what kind of sectors?
things like commodity producers,
Yeah.
automakers, they saw gains on this news.
Makes sense.
I mean, it makes
Those
sense.
are the ones that would feel it first, right?
Yeah, exactly.
If we did have those broad tariffs,
They'd be hit the hardest.
yeah, even a hint that maybe it'll be a little more limited.
Relief.
Relief rally.
Yeah.
But we do have to be realistic here.
Oh, absolutely.
We have to keep a balanced perspective because, as Kathleen Brooks of XTB pointed out in the U.S. Treasuries article from Bloomberg, even if these tariffs are more targeted, there's still a ton of uncertainty.
Oh, yeah.
The devil is in the details.
The details.
Which sectors, which countries are we talking about?
Right. And, that uncertainty,
Always has an impact.
it has a knock-on effect.
Right. It affects global trade. It affects, the pace of economic growth.
Yeah. And Bloomberg had an interesting point in one of those articles. They said, what if the market overestimated the risk
Okay.
of the tariffs?
Yeah.
So what if this move to a more targeted approach actually leads to a reversal of that sell-off we've been seeing in U.S. equities?
Interesting. So they're saying that maybe we overreacted a little bit
Yeah.
to the initial news?
It's possible, yeah.
Okay.
And it's interesting because if we connect this to kind of the bigger picture,
Yeah.
we can look at what Frances Hughes said in her MarketWatch article, why Bitcoin's plunge could have further to go despite its recent bounce.
I saw that one.
Yeah. And she pointed out that the concerns about President Trump's trade policies,
Yeah.
they've been a factor weighing not just on the stock market, but on crypto as well.
Wow. So this tariff situation,
It's reaching far.
it's having a wide impact on different asset classes.
Okay, well, let's shift gears a little bit.
Sure.
And talk about something really interesting that's happening in the precious metals market.
Okay. What's that?
Specifically, different performances that we're seeing with gold and silver.
Oh, yeah. That is interesting how they've kind of diverged recently.
Yeah, and Myra P. Saifong at MarketWatch has written some great articles on this.
She's a great resource.
She is. And, gold, as we've all seen, has been on an incredible run.
Yeah.
Her article, Gold Hasn't Outperformed Stocks by This Much Since 2022. Here's what that means for investors.
I think I felt that one.
Yeah, it highlights that gold futures have not only gone up, but they've actually hit record highs. They've gone over $3,000 an ounce.
Wow.
Which is amazing. And, it's not just that it's gone up.
Right.
It's by how much it's outperformed the S&P 500.
Right. The magnitude of that.
Yes, and MarketWatch is saying that this is the widest margin we've seen since March 2022.
Wow.
And that's a pretty strong signal, right?
Yeah. What does that tell us?
Well, the article suggests that this kind of divergence often reflects pessimism among traders, and it could potentially indicate that stocks are nearing a bottom.
So they're seeing this as a potential signal.
A signal.
Yeah.
Okay, interesting.
And that's the historical pattern that MarketWatch is pointing to.
Stocks tend to rally
After gold is outperformed like this.
Yeah, after they've underperformed relative to gold for so long.
Okay, so potentially a buy signal for stocks then.
Potentially, yeah.
And what about gold then? What do they think?
They said that, gold being a safe haven asset
Right.
might actually experience some downward pressure in the near term.
Okay.
If that stock market rebound actually does happen.
It's interesting.
So it's like a little seesaw almost.
Yeah, one goes up, the other goes down.
Exactly.
Okay, well, what if you missed out on that gold run?
Well, Myra P. Saifong, she also has another great article on MarketWatch titled, If You Missed Out on Gold's Record Run, Take a Look at Silver.
Okay, silver.
And the outlook she's giving for silver is pretty optimistic.
Really?
Yeah.
What are they saying?
Well, analysts are predicting a pretty powerful upward move for silver. Some are even saying it could reach its own record highs.
Wow. Okay, that's pretty bullish.
Yeah, and what's really interesting is that silver has lagged behind gold.
Right. It hasn't had that huge run that gold has had.
Yeah. And, the gold to silver ratio.
Right, which tells you how many ounces of silver it takes to buy an ounce of gold.
Exactly.
Yep.
It's currently pretty elevated.
And historically, what does that mean?
Well, historically, a high ratio like that means that silver might be undervalued.
Compared to gold.
Yeah. Interesting.
And it's not just about, the relative value.
Right.
The fundamental supply and demand.
Yeah, the fundamentals have to be there, too.
For silver also look really good.
Okay, how so?
The Silver Institute is forecasting a huge supply deficit
Okay.
in the global silver market for the 5th year in a row.
Wow, 5 years in a row.
That's according to MarketWatch.
So a persistent shortage.
Yeah.
And when you combine that with the fact that investment demand is increasing,
Right, because of all this,
macroeconomic concerns or the geopolitical risks.
The same things that are pushing gold up.
Exactly.
And then you add in the robust industrial demand. Right. Silver's in everything these days. From electronics to solar panels, all those green energy technology.
Exactly. And it's only growing.
Yeah.
So the conditions seem really right.
For higher silver prices.
Yeah.
Wow. It all seems to point in that direction.
Yeah. But it's important to remember our conversation about tariffs.
Right, because those could have an impact.
Yeah. The Silver Institute, they cautioned that those potential tariffs from the Trump administration could impact silver investing, even with all that industrial demand.
Even with all that demand. Yeah.
It really shows how interconnected everything is.
It really does.
Yeah. You can't just look at one thing in isolation.
Everything affects everything else.
Yeah.
And one really interesting point that came up
Okay.
was this idea of a silver squeeze.
I agree.
Yeah.
What's that?
So Peter Spina from goldseek.com and silverseek.com, he brought this up.
Okay.
He said, you know what, if you have all these investors who are like, I want physical silver, And at the same time, you have all these traders who are short silver.
They're betting that the price is going to go down.
Exactly. And then suddenly they have to buy all the silver to cover their positions.
Right.
And that buying frenzy pushes prices way up.
So it's like a supply-demand kind of?
Reselling, yeah, exactly.
Wow. So it's like a short squeeze, but with silver.
Exactly. A silver squeeze. And we've seen that happen in other markets.
Yeah.
Whether or not it happens with silver, well, that depends on a lot of things.
Yeah.
But it's an interesting possibility.
Yeah, for sure. Okay, well, let's move on from the shiny world of precious metals and talk about something else that's causing a lot of debate.
Okay, what's that?
These comparisons that people are making between the current stock market and the dot-com bubble.
Oh, yeah, from 25 years ago.
That's right. And there's a Bloomberg article that really dives into this. Stumbling stock market raises specter of dot-com era reckoning.
I think I saw that one, yeah.
And a lot of this is fueled by all the excitement around AI.
Yeah. Artificial intelligence is definitely the hot topic these days.
And it makes sense that people are drawing parallels.
I mean, it does feel similar in some ways.
Yeah.
Right? We've got this revolutionary new technology.
Like back then, it was the internet.
Right now, it's AI.
Investors are super excited. Stock market's rallying.
Yeah, and people are worried about overheating.
Like, are we in a bubble?
Exactly. Those same concerns.
But the article makes a really important point
Okay.
about a key difference between now and then.
Oh, okay. What's that?
And this is really important for, anyone listening.
Right. So they don't get caught up in the hype.
Yeah, you don't want to just jump to conclusions based on history.
Exactly. History doesn't always repeat itself.
That's right.
So what's the big difference?
The financial health of these big tech companies today compared to the startups back in the dot-com era.
So the companies themselves are different.
Yeah, Bloomberg pointed out that companies like Alphabet, Amazon, Meta, Microsoft,
The big players.
they're making huge investments in AI.
Yeah, they're all this.
But they're still making a ton of money.
They're still profitable.
They're generating so much free cash flow.
Right, and that's not what we saw back then.
No, back in the late 90s, early 2000s, a lot of those internet companies.
They were just burning through cash.
Yeah.
With no clear path to profitability.
It was all about growth.
Growth at all costs.
Yeah.
Market share.
But not about profits.
Right, and that difference in profitability.
It shows up in the valuations.
Okay.
Bloomberg pointed out that the price-to-earnings ratios for these tech companies,
Yeah.
they're way lower than they were during the dot-com bubble.
Okay, that makes sense.
Because back then, some of those companies weren't even making money.
Right, so how do you even value them?
Right, they had to come up with all these different metrics.
Eyeballs.
Yeah, mouse clicks.
Things like that.
Just to try to justify these crazy valuations.
Right, because traditional metrics didn't really apply.
But it's a really important lesson to remember.
What's that?
That even with a game-changing technology like the internet,
which, obviously, in the long run, was a huge success.
it's a huge success, yeah. The timing of your investment.
Really matters.
Is everything right? The dot-com bubble proved that.
You can have the right idea.
Yeah.
But the wrong timing.
Exactly. And so the question that Bloomberg asks is this AI boom another example of the right idea at the wrong time?
That is the million-dollar question, isn't it?
Yeah. And, the long-term potential of AI could be huge.
No one's arguing with that.
But are the valuations today really reflecting that potential and the risks?
Right, because there are always risks.
Especially with technology that's moving so fast.
It's changing so rapidly.
Okay, well, let's touch on a few other headlines that I think are worth mentioning.
Okay, what else caught your eye?
Well, there was a really interesting article in MarketWatch by Steve Goldstein.
Okay.
Citing and decking coming together in $8.8 billion cash and stock deal.
Wow, that's a big deal.
Yeah, it was about James Hardie acquiring the AZEK Co.
I'm not familiar with them.
So AZEK makes outdoor building materials.
Yeah.
And James Hardie specializes in fiber cement products.
I see.
And what's interesting is that both of these companies could really benefit from this trend in home renovation and outdoor living.
Right, people are spending more time at home.
Yeah.
They want to spruce up their spaces.
Exactly. And James Hardie, they paid a pretty big premium for AZEK.
Okay.
And they think this deal is going to boost their earnings per share.
So they're expecting good things from this.
Yeah, but here's a funny thing.
What's that?
James Hardie's stock actually went down after they announced the acquisition.
Oh, that's interesting. Why do you think that is?
Well, it's not that unusual when you have these big deals because investors, sometimes they worry about
the risks.
Yeah, the integration risks.
Right. Can they actually make this work?
Yeah, or sometimes they think the price was too high.
Right. Maybe they overpaid.
Yeah, so it's something to watch.
Okay, something to keep an eye on.
Okay, and then there's this really interesting development happening in Japan.
Okay, what's going on over there?
There was an article in the Wall Street Journal by Megumi Fujikawa.
Okay.
Under pressure to raise wages, Japan's smaller firms get creative.
Interesting.
So the Bank of Japan, they've been pushing for higher wages.
Yeah, trying to get rid of that deflation.
Right. They want to get the economy moving.
That people spending.
But the smaller companies in Japan,
Yeah.
they're having a hard time keeping up with the bigger corporations.
Who were offering those big salary increases.
Exactly. And so what they're doing is actually pretty clever.
Okay, what are they doing?
Instead of giving huge raises,
Yeah.
which can be a big fixed cost,
Right.
they're boosting employee benefits.
Like what kind of benefits?
Things like subsidized meals
Okay.
or better transportation allowances.
I see. So things that help with the cost of living,
Exactly.
but without that long-term commitment of a big salary bump.
Exactly. But the article did point out that there could be a downside.
What's that?
Workers might feel like they're not really getting ahead.
Right. If their base pay isn't going up,
Yeah.
then they might start looking for other jobs.
Exactly.
Yeah. So it's a tough situation.
Yeah, it's a balancing act for these smaller firms.
They're trying to do the right thing,
Mm-hmm.
but they also have to protect their business.
Absolutely. Okay, and then there was this article in the Wall Street Journal by James McIntosh.
Okay.
It was called "The Dumbest Investment in the World Was Better Than Owning Safe Treasuries."
Okay. That's a provocative title.
It is, right?
I'm intrigued. What was this dumb investment?
So it was about Argentina's defaulted century bond.
Oh, wow.
Yeah.
Argentina.
Yeah.
They've had their share of debt problems.
They have, and so back in 2017 when they issued this 100-year bond,
Yeah,
people were very skeptical
I can imagine.
because Argentina has a history of,
Insulting.
defaulting, yeah.
Oh.
And sure enough,
He did it again.
they defaulted just 3 years later.
Wow. So that's where the dumb investment comes in.
Yeah, but here's the twist.
Okay.
The investors who held onto those bonds, and they got the restructured bonds as part of that settlement,
Okay.
and they collected those original high coupon payments.
Mm-hmm.
They actually ended up making more money.
Than if they had invested in U.S. Treasuries.
Exactly.
Wow. So the dumb investment actually outperformed the safe investment.
That's right.
So what's the lesson here?
Well, McIntosh is arguing that when risks are really obvious,
Yeah.
they're often priced in.
Right. You get compensated for taking on that risk.
Exactly. But then those safe assets
Mm-hmm.
can have hidden risks.
Well, go away.
Well, like we've seen with those low-yielding government bonds,
Right.
when inflation starts going up,
Your real return is negative.
and then, of course, you have the unpredictable nature of politics.
Yeah, that can really throw a wrench in things.
Like what's been happening in Argentina with President Milei.
Right. All those reforms he's been making?
So it's a good reminder that nothing is completely risk-free.
No. Even the safest investments have some risk.
Okay, and then finally, let's look at what the options market is telling us.
Okay. What are they saying?
So there's a Bloomberg article by David Marino, Christian Das, and Bernard Goiter.
Okay.
And the headline is Options Market Focused on Jobs and Inflation Over Tariff Reveal.
Interesting. So even though those tariffs are coming up,
Yeah.
that's not what options traders are most worried about,
Exactly. And they're looking at the implied volatility.
right? Which basically tells us how much the market thinks prices are going to swing.
Yeah. And they're seeing a greater demand for protection around the dates that the core PCE price index
Which is a measure of inflation.
and the U.S. unemployment data are coming out.
Okay, so they're worried about inflation and jobs,
Yeah. And those releases are scheduled for around March 31st and April 4th.
which is right after those tariffs are supposed to be announced.
Yeah, so it seems like the options market is more focused on those economic indicators
Right. They want to see how the labor market and inflation are reacting.
to the current environment, which could, of course, be influenced by those tariffs.
Right. But it's not just about the tariffs themselves.
It's about the bigger picture.
Yeah. How's the economy actually doing?
Exactly. And the article pointed out that we haven't seen these huge spikes in the VIX.
The volatility index.
Yeah, which could mean that some investors have already adjusted their portfolios.
Or maybe they've moved their money to other markets.
So they don't need as much downside protection.
Interesting.
So to sum up our Monday morning deep dive,
Yeah, we covered a lot of ground.
we did. We talked about how the market is reacting to those potential tariffs.
The targeted tariffs from President Trump
Yeah, the strength of gold.
and the potential for silver to catch up
That debate about AI and the dot-com bubble.
and those key differences.
Right, and then we talked about that M&A activity in the building materials sector,
And what those Japanese companies are doing with wages
those creative benefits, and the surprising returns from Argentina's debt.
and what options traders are focused on.
It's a lot.
It's a multifaceted picture.
But hopefully this deep dive has given you a better understanding of all the key themes that are at play.
And how they're all connected.
Yeah, because, it can be overwhelming with so much information out there.
Absolutely.
But when you can see how trade policy inflation, precious metals, and the lessons from history
all tied together,
it can make you a more confident investor.
It can help you cut through the noise and make better decisions.
Exactly. So we encourage you to think about how all these different factors might affect your own perspective.
Your own investments.
And as you follow the markets in the coming weeks.
Absolutely great advice.
And with that, I think we've reached the end of our deep dive.
I think so too.
We'll see you all tomorrow morning
with more headlines
from those major financial magazines.
See you then.
Bye, everyone.